Imagine waking up tomorrow morning to find that the stock market has suddenly erased nearly $2 trillion in value before lunchtime. Television anchors are speaking faster than usual. Financial analysts are refreshing charts every few seconds. Headlines flash across every major news outlet. The AI rally is over. Tech stocks lead massive sell-off. Investors rush for the exits. For millions of Americans, this wouldn't just be another headline. It would affect retirement accounts, pension funds, college savings plans, and investment portfolios across the country. The question is, would anyone really be surprised? Because beneath the excitement surrounding artificial intelligence lies a growing concern that Wall Street has seen many times before. History has a habit of repeating itself, not in exactly the same way, but often with remarkably familiar patterns. Every major investment boom begins with a breakthrough that changes the world. Railroads, electricity, automobiles, the internet, smartphones, and, today, artificial intelligence. Unlike many investment trends that disappear after a few months, AI is already transforming industries around the globe. Companies are rewriting software, hospitals are testing AI-assisted diagnostics, banks are automating customer service. Manufacturers are improving efficiency. Students, teachers, engineers, lawyers, and marketers are all finding new ways to use AI every day. The technology is real. The opportunity is enormous. But that isn't what worries experienced investors. Their concern isn't whether AI will change the world. It's whether Wall Street has become too optimistic about how quickly that future will arrive. Markets don't simply reflect reality. They attempt to predict the future, and sometimes they become far too confident. Over the past 2 years, investors have poured hundreds of billions of dollars into companies connected to artificial intelligence. Many of the largest technology companies have reached record-breaking valuations. Some businesses have seen their market value increase by hundreds of billions or even trillions of dollars in a relatively short period. The excitement has become so intense that nearly every earnings call now includes discussions about AI. Executives know investors want to hear those two letters, AI. Mention them often enough, and Wall Street tends to pay attention. But experienced market veterans know something important. Excitement alone has never guaranteed long-term success. Throughout American financial history, nearly every great innovation has attracted massive speculation. Sometimes those investments created incredible wealth. Other times, they created spectacular bubbles. The difference usually becomes clear only after it's too late. That's why today's rally has sparked an uncomfortable debate across Wall Street. Are investors witnessing the beginning of another technological revolution, or are they watching another financial bubble inflate before their eyes? Because despite record highs in major stock indexes, something unusual has been happening beneath the surface. The market appears healthy, but much of that strength is coming from only a small number of companies. That concentration has left many professional investors asking a difficult question. What happens if those few companies disappoint? The answer could determine not only the future of AI stocks, but the direction of the entire US stock market. To understand today's market, we first need to understand why investors became so fascinated with artificial intelligence. The story didn't begin with stock prices, it began with technology. For decades, AI remained largely confined to research laboratories and specialized industries. Most Americans rarely interacted with it directly. That changed dramatically when advanced generative AI became widely available. Suddenly, millions of people could ask questions, generate images, write code, summarize documents, and solve complex problems within seconds. The public saw something that felt different. This wasn't just another software update. It felt like the beginning of an entirely new computing era. Businesses reacted immediately. Executives feared being left behind. Investors feared missing the next big opportunity. And Wall Street began searching for the companies most likely to benefit. Some names quickly emerged as clear leaders: chip designers, cloud computing providers, software companies, data center operators, cybersecurity firms, infrastructure suppliers. Every layer of the AI ecosystem suddenly became attractive. Yet, one company stood out more than any other: NVIDIA. Its graphics processing units, better known as GPUs, had originally been designed for gaming, but those same chips proved extraordinarily effective at training advanced AI models. Demand exploded. Technology giants raced to secure enough hardware to build increasingly powerful AI systems. Supply struggled to keep up. Revenue surged. Profits climbed even faster. Investors responded by driving the company's market capitalization to levels that would have seemed almost unimaginable only a few years earlier. But NVIDIA wasn't alone. Microsoft invested heavily in AI partnerships. Alphabet accelerated development across its products. Amazon expanded cloud infrastructure. Meta dramatically increased spending on AI research. Apple entered the conversation with new AI initiatives. Collectively, these companies became the engine powering much of the broader market. Their enormous size meant that gains in just a handful of stocks could lift major indexes higher. For many investors, the logic seemed straightforward. If AI transforms the global economy, then today's leaders could become even more valuable tomorrow. That belief fueled extraordinary optimism. Investment funds increased exposure. Individual investors followed. Financial media devoted endless coverage to AI. Every earnings report became an event. Every product announcement moved markets. Companies that merely mentioned artificial intelligence often saw their stock prices jump. Some businesses rebranded themselves around AI despite having limited involvement in the technology. Sound familiar? Veteran investors thought so, because similar behavior appeared during previous speculative booms. Whenever investors become convinced that an entirely new era has arrived, excitement can begin to outweigh careful analysis. That's when markets become vulnerable, not because the technology is fake, but because expectations become almost impossible to satisfy. And expectations, more than anything else, determine stock prices. At first glance, America's stock market appears stronger than ever. The S&P 500 reaches new highs. The Nasdaq continues climbing. Investment accounts recover. Confidence grows. But beneath those impressive headlines lies an important detail that many casual investors never notice. The rally hasn't been evenly distributed. Instead, an unusually small group of companies has been responsible for an outsized share of the market's gains. Market professionals sometimes describe this as concentration risk. Imagine carrying a heavy table. If 10 people are sharing the weight, losing one person isn't catastrophic. But if only 3 people are doing all the lifting, one stumble changes everything. That's essentially what has happened inside today's stock market. A handful of mega-cap technology companies now represent an extraordinary percentage of the total value of major US stock indexes. Because these firms are so large, their movements influence nearly everyone, even investors who don't intentionally own technology stocks. Many retirement accounts automatically hold them through index funds. Pension funds hold them, mutual funds hold them, exchange-traded funds hold them. Millions of Americans are invested in these companies, whether they realize it or not. That concentration creates both opportunity and risk. When these companies perform exceptionally well, the entire market benefits. But when they disappoint, the effects ripple across Wall Street. This phenomenon has become increasingly visible during earnings season. Sometimes one company's quarterly report can move hundreds of billions of dollars in market value within hours. Few periods in American financial history have seen so much influence concentrated in so few corporations. Supporters argue there's nothing unusual about this. After all, these businesses generate enormous profits. They dominate global markets. They possess world-class engineering talent. They continue investing tens of billions of dollars into artificial intelligence infrastructure. Perhaps they genuinely deserve their premium valuations. Critics, however, see another possibility. They worry investors are assuming that today's extraordinary growth will continue almost indefinitely. History suggests that assumption rarely survives unchanged. Every great company eventually faces challenges. Competition increases. Growth slows. Customer demand matures. Regulatory scrutiny intensifies. Economic conditions shift. None of those outcomes necessarily destroy a business, But even small disappointments can have enormous consequences when expectations have climbed this high. That's why experienced investors aren't asking whether artificial intelligence is real. Most agree that it is. The more difficult question is whether stock prices have already anticipated years of future success. If expectations have moved too far ahead of reality, even excellent companies can see their shares fall sharply. And because so much of today's market depends on those few giants, the next chapter of the AI revolution may determine far more than the future of technology. It could determine the direction of Wall Street itself. By this point, one thing should be clear. The concern surrounding today's market isn't that artificial intelligence is a bad technology. Far from it. Most economists, business leaders, and technology experts agree that AI has the potential to reshape industries on a scale comparable to the internet or even electricity. The real question is much more uncomfortable. Can an incredible company still become a risky investment? History says yes, and that distinction has trapped investors countless times. Many people assume that if a company is successful, its stock must automatically be a good investment. But the stock market doesn't reward companies simply for being great. It rewards companies for performing better than investors already expect. That's a crucial difference. Imagine buying a brand new sports car for twice its normal price because everyone believes it will become even more valuable next year. Even if the car performs perfectly, you've still paid so much that future gains become increasingly difficult. Stocks work in much the same way. The higher expectations climb, the harder they become to satisfy. This is where the concept of valuation enters the conversation. Valuation is essentially Wall Street's attempt to answer one simple question. How much is this company truly worth today based on the profits it can generate tomorrow? No one knows the exact answer. Every valuation is built on assumptions. How quickly will revenue grow? Will profit margins expand? Can competitors catch up? Will customers continue spending? The further investors look into the future, the more uncertain those assumptions become. During periods of optimism, those uncertainties often fade into the background. Investors begin projecting years of uninterrupted growth. Every product launch becomes a success. Every quarterly report exceeds expectations. Every setback feels temporary. But reality rarely follows a perfectly straight line. Businesses face delays. Economic conditions change. Consumer demand shifts. New competitors emerge. Government regulations evolve. Even the world's strongest companies experience periods of slower growth. That doesn't necessarily mean the business is failing. It simply means expectations may have moved ahead of reality. And when expectations become too ambitious, stock prices can react violently, even if the underlying company remains fundamentally healthy. This is why experienced investors often repeat a simple phrase: price matters. Buying an outstanding company at a reasonable valuation can be an excellent investment. Buying the same company at an unrealistic valuation can produce disappointing returns for years. That's the balance Wall Street is trying to measure today. No one doubts that AI is transforming the economy. The uncertainty lies in whether investors have already priced in too much of that future. Because if today's prices already assume years of extraordinary success, what happens when reality turns out to be merely excellent instead of perfect? Whenever markets experience extraordinary enthusiasm surrounding new technology, comparisons inevitably begin. For today's AI boom, one historical event dominates nearly every conversation: the dot-com bubble. During the late 1990s, the internet captured America's imagination. Businesses rushed online. Investors believed the digital economy would transform every aspect of daily life. And in many ways, they were right. The internet did change the world. Companies like Amazon eventually became some of the most valuable businesses in history. But there was one major problem. Investors couldn't distinguish between companies with sustainable business models and companies fueled almost entirely by speculation. As excitement spread, stock prices climbed at breathtaking speed. Many firms generated little revenue. Some had no profits at all. Yet, billions of dollars flowed into businesses whose futures depended more on hope than proven performance. When expectations finally collided with reality, the bubble burst. The Nasdaq Composite lost nearly 80% of its value over the following years. Countless companies disappeared. Millions of investors suffered significant losses. It became one of the most famous financial bubbles in American history. Naturally, many people wonder whether AI is following the same path. The similarities are difficult to ignore. A revolutionary technology, rapidly rising stock prices, intense media attention, fear of missing out, investors chasing the next transformative company. But there are also critical differences. Unlike many internet startups during the dot-com era, today's largest AI companies are already highly profitable. They generate billions of dollars in annual earnings. They operate global businesses with diversified revenue streams. They possess enormous cash reserves and invest heavily in research, infrastructure, and talent. In other words, today's market leaders aren't speculative startups operating from small offices with ambitious promises. They're some of the most financially powerful corporations ever created. That distinction matters. It suggests today's market may not be experiencing the same kind of speculative excess that defined the dot-com bubble, yet it doesn't eliminate risk. History teaches another important lesson. Strong companies can still experience severe stock declines if expectations become too optimistic. Sometimes the business continues succeeding while the stock price struggles for years, simply because investors paid too much during periods of peak enthusiasm. That's why many analysts hesitate to label today's market as a bubble. Instead, they ask a more nuanced question, not whether AI will succeed, but whether investors have become too confident about how quickly that success will translate into future profits, because timing has always mattered just as much as technology itself. If soaring expectations are one side of the equation, interest rates are the other. For years, investors benefited from an environment of historically low borrowing costs. Money was inexpensive. Companies could finance expansion more easily, consumers spent more freely, and investors were willing to pay premium prices for businesses expected to generate profits far into the future. That environment helped fuel one of the strongest bull markets in modern history. But inflation changed the equation. As prices climbed across the US economy, the Federal Reserve began raising interest rates in an effort to slow demand and bring inflation under control. Higher interest rates affect nearly every corner of the economy. Businesses face higher borrowing costs. Consumers become more cautious. Mortgage payments rise. Corporate financing becomes more expensive. And investors begin reevaluating what future profits are worth in today's dollars. For high-growth technology companies, this matters even more. Much of their valuation depends on expectations of strong earnings years into the future. When interest rates rise, those future earnings become less valuable from today's perspective. That doesn't mean AI companies suddenly stop growing. It means investors become more selective about how much they are willing to pay for that growth. At the same time, these companies continue investing enormous sums into the AI race. Building advanced data centers, designing specialized chips, purchasing computing power, and hiring elite engineering talent require tens of billions of dollars. So far, many of America's technology giants have been able to support those investments because they generate substantial cash flow from existing businesses. But Wall Street will eventually expect those investments to produce measurable financial returns. The questions investors are asking are becoming increasingly practical. Will AI products generate enough revenue to justify today's spending? Can businesses maintain healthy profit margins while investing at such a rapid pace? And, perhaps most importantly, how long are investors willing to wait? History shows that financial markets are remarkably patient during periods of optimism, but that patience can disappear surprisingly quickly if earnings fail to keep pace with expectations. For now, the AI story remains supported by strong corporate profits and continued demand. Yet, the balance between innovation, investment, and valuation has rarely been more important. No one, not economists, hedge fund managers, or central bankers, can predict the market with certainty. But, based on history and current conditions, three broad scenarios appear possible. The first is the most optimistic. Artificial intelligence delivers productivity gains faster than expected. Businesses successfully integrate AI into everyday operations. Corporate earnings continue expanding. Consumers benefit from new products and services. In this scenario, today's elevated valuations gradually become easier to justify because profits grow into them over time. Rather than a bubble bursting, the market simply grows into its expectations. The second scenario is far less dramatic, but perhaps more likely. Instead of a crash, the market experiences a healthy correction. Stock prices decline as investors reassess valuations. Some companies fall more than others, particularly those with the highest expectations. Yet the broader economy remains stable. Corporate earnings continue growing, albeit at a slower pace. Historically, corrections have been a normal part of long-term investing. While they can feel unsettling in the moment, they have often helped reset valuations before the next phase of growth. The third scenario is the one that receives the most attention, but also the one that deserves the most caution when discussing. If economic growth slows significantly, corporate earnings disappoint, and investor confidence weakens at the same time, the market can face a much further decline. Because so much of today's rally has been driven by a relatively small number of large technology companies, a reversal in sentiment toward those firms could have an outsized impact on major indexes. That possibility is precisely why experienced investors continue monitoring earnings reports, economic data, consumer spending, and Federal Reserve policies so closely. None of these scenarios is guaranteed. Markets are influenced by thousands of factors unfolding simultaneously. Innovation may continue at an extraordinary pace. Competition may intensify. Economic conditions may improve or deteriorate. The future will almost certainly contain surprises that no forecast fully captures. Perhaps the most important lesson is this. The debate surrounding today's market is not really about whether artificial intelligence will matter. Few people doubt that it will. The real debate is whether today's stock prices already reflect tomorrow's success. And on Wall Street, that distinction has often made the difference between extraordinary long-term returns and painful short-term disappointment. As we've seen throughout history, every technological revolution has been accompanied by enormous optimism. Railroads reshaped transportation. Electricity transformed industry. The internet connected the world. Today, artificial intelligence appears poised to become the next chapter in that story. The evidence is difficult to ignore. Businesses are investing billions of dollars. Researchers continue making breakthroughs at an astonishing pace. Consumers are adopting AI-powered tools faster than many analysts expected. Governments are developing new policies to address opportunities and risks. This isn't science fiction anymore. It's becoming part of everyday life. And that's exactly why today's market has captured so much attention. Because Wall Street isn't simply investing in today's AI products. It's investing in what artificial intelligence might become 5, 10, or even 20 years from now. That is both the market's greatest strength and its greatest vulnerability. History reminds us that markets rarely move in a straight line. Periods of extraordinary innovation are often followed by moments of uncertainty. Excitement gives way to questions. Optimism meets reality. Some companies exceed expectations. Others struggle to deliver on ambitious promises. That process isn't a sign that innovation has failed. It's how markets separate sustainable businesses from unrealistic expectations. For long-term investors, that distinction matters far more than the daily headlines. A sharp decline in stock prices does not necessarily mean the underlying technology has failed. Likewise, record-breaking market highs do not guarantee future gains. Successful investing has never been about predicting tomorrow's closing price. It's about understanding the difference between a company's long-term potential and the price investors are willing to pay for it today. That may be the most important lesson of the current AI boom. Artificial intelligence could become one of the most transformative technologies of the 21st century. It could improve healthcare, accelerate scientific discovery, increase productivity, and reshape countless industries. At the same time, markets can become overly enthusiastic about even the most promising innovations. Those two ideas are not mutually exclusive. In fact, history suggests they often happen together. The challenge for investors isn't deciding whether AI will change the world. It's determining whether today's valuations already assume that success has arrived, because markets are forward-looking. By the time a revolutionary technology becomes obvious to everyone, investors have often spent years trying to price that future into today's stock market. Sometimes they estimate correctly, sometimes they don't. No one knows exactly how this chapter will end. Perhaps AI companies will continue producing extraordinary earnings that justify today's optimism. Perhaps growth will slow, allowing valuations to gradually return to more sustainable levels. Or perhaps the market will experience periods of volatility before eventually finding a healthier balance. All three outcomes remain possible. That uncertainty is not a weakness of the market, it's one of its defining characteristics. Wall Street has always been driven by expectations, and expectations are constantly changing. For individual investors, the lesson may be simpler than it first appears. Instead of chasing every headline or reacting to every market swing, focus on understanding the businesses behind the stock prices. Ask difficult questions. How durable is the company's competitive advantage? Can it continue growing profits over the long term? Are expectations realistic, or have they become overly optimistic? Those questions have guided successful investors for generations. They remain just as relevant in the age of artificial intelligence. Years from now, historians may look back on this period as the beginning of a technological transformation that changed the global economy. Or they may remember it as another example of investors allowing excitement to outrun reality, at least for a while. Today, we simply don't know. What we do know is that innovation has always rewarded patience more than speculation. The companies that ultimately shape the future are not always the ones with the loudest headlines or the fastest rising stock prices. They are the ones that consistently create real value over time. So, the next time you see another record high on Wall Street, or another headline celebrating the unstoppable rise of artificial intelligence, remember that behind every market rally lies a simple question that investors have been asking for more than a century. Are we witnessing the early stages of the next great American innovation? Or are expectations moving faster than reality can keep up? Only time will provide the final answer. Until then, the AI boom remains one of the most fascinating and closely watched financial stories of our generation.